Hello and welcome to the Mutual Fund Show. I'm Neeraj Shah. Over the next 25 minutes, we'll talk all about mutual funds. But first, we have an exclusive story for you. October retail flows into mutual funds have stayed the course, or in fact have gone up higher. My colleague Sajid Johnson with all the details. Sajid.
I've been talking to the mutual fund industry, and they've been saying very categorically that net inflows into equity schemes have been to the tune of 30 to 35,000 crores in October. Now, this is similar to what we have seen in September and August, and that number continues to be there, and there is no disturbance to this net inflows coming in because of the correction we have seen. Now the indices, to give a perspective, indices have fallen by nearly 10% from their tops, and a lot of volatility has happened. But retail investors have continued to pour in money into mutual funds. On a gross level, it's around 65,000 crores which have come in. There has been redemptions which have been at par with every month of 25 to 30,000 crores, and net flows which is coming in is around 30 to 35,000 crores. Now, AMFI will come out with the numbers in the next couple of days, but what we understand is that this flows continues. And what is important is that SIPs are continuing. Say 40 to 45 lakh new registrations are happening every month, and that continues in October as well. And the spread of the SIPs or the flows which are coming into into the industry or mutual funds is across the month. So it's not just that is happening in the first 10 days or 15 days of the month, and that's the reason why the flows have come in, but it's spread across. A lot of digital channels have been used, and so the money is coming in as we speak. We also understand that of these 35,000 crores, one-third have gone to sectoral and thematic funds, which is the theme for the last couple of months, which has been there, and then followed by multicaps, flexi, small cap, and mid caps, which have seen in. Now, to give a perspective, we had nearly 33 NFOs that came in the month of October. Two-thirds of them, around 22 or of them, were index fund NFOs which came in. So, thematic wise, there hasn't been many equity fund launches which have happened, but you adjust for that NFOs which are coming in and the flows which are coming because of the NFOs, the fund flows have been normal as compared to, there's no disruption to the retail flows.
Sure.
In perspective, DIs invested 1.07 lakh crores, and mutual funds alone invested 94,000 crores in the month of October. Right. That's 3 times what we saw in August or July or something.
Okay, Sajid, you may have questions for our guests. Stay on for a bit. Let's get in. Salonee Sanghvi, founder of My Wealth Guide, and Santosh Joseph, founder of Germinate Investor Services, on the show. And to both of you, thanks so much for joining in. Happy New Year, of course. And a lot of people say that investors should be handheld during tough times. I think that would have done with finesse by people like you, because the inflows, as Sajid has figured out, into October, which was considered to be a pivotal month, considering that they've been very volatile, the markets, the inflows look rock solid. So kudos on that. Just a bit of this before we get to our topic of how to design funds. Salonee, I'll start with you. Did your set of investors or people that you are your clients, did they show some thoughts of stopping their SIPs or redeeming some of the funds because the markets were volatile in the month of October, or not really?
So I think what has happened is a lot of investors, have started their investing journey in 2020. So, what they've seen is even if the markets have fallen, they've recovered pretty quickly. So I think what the mindset has changed in the sense that if markets are falling, it's a good time to actually add funds. So a lot of our clients have actually amount of funds to take advantage of the market fall.
Okay, Santosh, what about you? What's your experience been? Did investors show the propensity to take money off the table, and did you have to handhold them very carefully, or was it behavior as usual?
Hi Neeraj, quite the contrary. I'm brimming with happiness to tell you October 2024 has actually been one of our best months ever in terms of net inflows and net investments. Now, initially, we were also a little, worried about how investors would behave considering how October started. And, you have too much going in the markets in terms of news flows and volatility and war and, the American elections at hand. But we registered one of the best months in recent months and years. So, therefore, we've seen great exemplary activity by investors to number one, stay put, number two, stay strong, and three, to add more.
This is music to the ears, and this is music to the ears simply because it shows the behavior of the Indian mutual fund investor. And I think, a lot of people talk about, whether there is, at what point of time will the Indians be over-invested in equities. I think we are multiple years away from that, so no issues right now. But having said that, because it's been a volatile month, I think it becomes important to try and understand how should people design a mutual fund portfolio for the current times. I mean, should there be changes made relative to what has been the case in the recent past? Now, Salonee, I'll start with you. It's impossible to predict whether we will have a V-shaped recovery again or no. It may happen, it may not. So therefore, for somebody who is coming to you right now, Salonee, and asking how would you design a portfolio of funds to suit the current times as they are right now, and keeping an eye in the future, of course, what would your advice be?
If somebody comes to me now with their portfolio saying that this is it, what should I do? Should I make changes? I strongly believe that one should invest basis their asset allocation, which is derived from the amount of risk they're comfortable taking and the time that they're going to stay invested. So the time that they will need to withdraw the funds. So it is very important to kind of make sure that you stay within that asset allocation, because equity is not a short-term investment. When you're looking at an equity investment, you're looking for at least a 5-year horizon, if not longer. So just to give you a sense, say if someone has a more conservative risk-taking, ability, and they're looking at a 5 to 10-year kind of horizon, then maybe they should stick to, large cap, flexicap, or index funds. For someone who has a more balanced risk-taking capacity, they can also look at adding mid-cap funds to that. And only for those who are extremely aggressive and have a 5 or a 7-year plus kind of horizon, then we can also add a little bit of small cap in that case. So I think the investment strategy and the portfolio has to be driven by each person's risk-taking capacity and the time, rather than simply just what is happening in the markets around. Because if you look at the markets around, we saw the Russia-Ukraine war, we're seeing a lot of geopolitical events happening right now. And that happens every single year. There's always something happening. So you cannot make portfolio decisions basis that.
Okay. Okay, so that's the opening amble, and I'll come to specifics as well. But Santosh, I'll come to you with the same topic. Would the strategy of building a mutual fund portfolio currently be different as of now versus what it may have been, say, 12 months ago? Why or why not?
So, Neeraj, interestingly, October 2023 was also a very volatile month. It started on the 7th of October when the Israel-Hamas war started, and it peaked out on 23rd of October. We had a 10 to 12% correction, so identical to how October last year and this year has been. Now, your question is extremely good for all our viewers, because in moments like these, where you have so much of news flow and so much of volatility, it is going to be most appreciated to ask that question: how do we build a portfolio? While I absolutely agree with just what Salonee so wonderfully put it together, saying that irrespective of the events and market activity, you build your portfolio based on your individual risk and reward profile along with the time. Now, it's a nice reminder in events like this that you stick to the basics. That is, do not let the news and the immediate actions change your investment behavior. Stick to the fundamental aspects of asset allocation, knowing for what you're investing and the risk category and the asset quality. Now, Only in times like these will we pay attention. If the markets were buoyant and if the markets were extremely exuberant, like how it was a little before the last month and a half, there was no caution to any of these metrics. But today, I think people will appreciate and understand it better. For all you know, maybe November, December, like the way it happened last year, markets can, in what you were trying to say, could be a V shape, may not be a V shape. That doesn't change how we build robust portfolios.
So now I'm going to ask you pointed questions. Santosh, I'll start with you. Add hybrid funds, yes or no?
Absolute yes.
Why so?
See, hybrid funds today give investors, whether old or new, the opportunity of getting asset allocation pre-mixed into their investment. Having some bit of fixed income today or any given point of time is good. You can decide in the hybrid funds what type of fixed income exposure and what percentage, and if it's going to be dynamically managed or not. Building hybrid funds is the good way to do it, because even if you don't buy a hybrid fund, you at any point will have to build a hybrid portfolio of mix between equity and fixed income, or maybe a third asset class. So therefore, an absolute yes on hybrid. You choose the hybrid breakup for your convenience.
Okay. Salonee, is that the better way to do debt allocation in the portfolio, or would you add directly debt funds, pure debt funds? Why or why not? Also, Salonee, the timing, considering that the Fed may do what it does, the Indian RBI may do what it does, should one add debt funds at the current juncture?
So ideally, people should invest basis their asset allocation. So, the mix of debt and equity. But what happens in reality is a lot of investors don't follow asset allocation because they may not know how, or they lack the discipline to rebalance the portfolio. So I think hybrid funds are a great idea in that case. They help you get equity exposure. They'll give you higher returns than debt, and they'll help you navigate the market volatility. Obviously, since these funds have a larger percentage in equity, barring the conservative hybrid funds, one should definitely look at least a 3 to 5 year holding period when one is investing in hybrid funds. In terms of debt funds, I wouldn't recommend adding debt funds simply because the markets have fallen and people are expecting a correction. Debt funds, they have certain roles basically for conservative investors, those who don't want to take higher risks that equity comes with, or for people who want regular income, or individuals who want to park short-term money with higher liquidity. So, or you want to diversify, you already have a lot of equity and you're looking to add a cushion, in that case, then debt funds are a great option. Again, as you said that, RBI may look at cutting rates. We've been expecting that for a while, so in that case, debt funds will definitely gain advantage because obviously if RBI cuts interest rates, your return on debt funds will be slightly higher.
Noted. Okay. Santosh, should one reduce the intensity of the SMID or the small and mid cap SIPs in favor of large cap funds at the current juncture? Why or why not?
My answer is no, because the product, the nature of investing in SMIDs through SIP is actually the main purpose of why you invest for long term in small and mid cap. In fact, anytime between choosing a lump sum versus a SIP, in an SIP, you are approaching the small and mid caps in a better format. Therefore, do not reduce the intensity. If your time horizon is long enough, I think you should continue. And if ever you're looking at some reallocation, only then it's an opportunity. Otherwise, my answer would be plain and simple. There's no need to reduce the intensity, but just ensure the time horizon for which you have predetermined is kept in mind, or hold it for longer.
Salonee, your answer differs, and it's okay to be different, of course, but does your answer differ?
I agree with Santosh on this. Obviously, we've seen a lot of investment in small and mid cap over the last 6 years, and there has been a lot of concern. And large cap companies, especially in times of volatility, tend to be far more resilient. But what we've seen is, interestingly, in the recent sell-off by FIIs, they've actually impacted large cap funds more than mid and small cap. So I would recommend redeeming or reducing your SIPs only and only if the proportion has become much higher than you need to have in your portfolio. Only then, to rebalance your portfolio, can you look at either stopping or redeeming the funds from that segment. Otherwise, again, stick to your asset allocation or and invest basis that. Another thing, again, as you said, I would avoid lump sum investments in the segment currently and look at either an SIP or an STP, spreading it over a few months. And just a disclaimer, small cap investments especially should be done for at least a 7+ year horizon.
Okay, okay. So that's, well, okay, an interesting one out there too. So that's the view on whether or not you should change the mix of your SMID funds, specifically small and mid cap funds, and hence brings me to my last question, which is what to do with multi-cap funds. And viewers, then we'll answer your queries as well, but multi-cap funds important too, because there is a distinction. 50% is large caps or what have you, but there is a minimum 50% in mid caps and small caps, unlike a flexi cap fund. And therefore, for people who are doing an SIP in the multi-cap route, Santosh, should people stay with it?
In fact, my personal favorite for most investors for an all-weather equity fund is the multi-cap. Now, you just brought about that important large cap allocation. Now, the multi-caps are possibly the only diversified equity category where you have a minimum that you need to maintain in medium, small, and large cap. Therefore, it eliminates the need to have separate or unique line items of small cap and mid cap, which is what was your previous question. Should we reduce the intensity? In a multi cap, that issue doesn't arise over here, because in a multi cap, you've got all the three, a little bit of discretion to the fund manager to increase or decrease the allocations to small and mids if they feel the valuations are stretched or it's overheated. But from a long-term investor perspective, I would personally choose multi-cap slightly above even a flexicap, thanks to flexicap having a large cap exposure, because this gives you a well-rounded exposure to large, mid and small cap, and therefore large caps being the biggest part and mid and small caps being well represented. It also gives you the luxury that this is the category where if you hold for a long time, you get rewarded across mid cap and large cap and small cap, not worrying that you missed out the bus. For example, the last 2 to 3 years, missing out on small and mid cap in a large cap fund or in any other fund would have put you back. But multi-cap, if you notice, has been extremely good in capturing the market momentum, especially in the play across market caps. So it's one of my favorite diversified equity teams and all-weather category in equity.
Okay. So that's the long and short of the questions that I had. Now, a bunch of queries, and Salonee, I'd like to start this with you. By the way, I don't know, sorry, Salonee, quick 30 seconds. Do you differ on the multi-cap view before we get to queries?
I have a slightly different view, because the multi-cap requires a minimum of 25% across large, mid, and small. I feel it may be an aggressive strategy and not suitable for all investors. So, it would depend on the risk-taking ability. I feel, flexi-cap funds have more flexibility of investing across the three segments and maybe a better option for most investors, depending on their risk profile. Most flexi-cap funds have a large cap bias. So in case if people need a higher mid or small cap exposure, I would recommend adding that with a separate fund rather than using a multi-cap fund, for their investment.
Okay, fair call. And horses for courses, depending on whose view gels better with you, viewers, you can go with that. Remember, there are not necessarily, there's not just a route A or route B. Both could work for you depending on how your psyche is as well. And it's great to have an advisor, by the way, to guide you through these things and not necessarily always do it yourself. But if you are a DIY investor, tune into our show. We'll try and answer as many queries as we can. So let's get the first one going. It's from Mike. Mike is aged 22 years. Salonee, Mike says it's currently invested in SBI small cap, Quant small cap, UTI 50 and Quant Flexi, and started this year and is planning to hold it for the next 10-12 years. Should Mike continue the SIP when markets are down like this?
So I would break this up into two. One is in terms of the selection of the funds. I don't know the exact amount going to each SIP, but it seems like it's extremely biased towards the small cap category. So I think that is something that definitely would need a relook, and adding maybe some more of large cap allocation as well. In terms of continuing the SIP, yes, I definitely think, because he's fairly young, he has a lot of time ahead of him. And the volatility significantly reduces over longer periods of time, So for a 1 to 3 year period, it'll be far more volatile. But if you look at a 7 to 10 year period, the volatility definitely reduces. So you should continue with your SIPs, but maybe relook at the funds that you're investing in to ensure that you have the right asset allocation.
Okay. The second question is from Bhagya. Again, 22 years. We have a lot of young investors today, which is a good thing. So Bhagya wants to start a 10% step-up SIP of 5,000 per month. Goal is to be financially independent by the age of 45. That's 23 years out. Santosh, how should Bhagya change the strategy on the current conditions? Currently, he's invested in the UTI Nifty 50 index to the tune of 1,500 rupees. Parag Parikh flexicap 1,500 rupees and Nippon India small cap 2,000. That's how he makes up his 5,000.
So the good thing is, must appreciate the young investors. Number one, putting up a nice portfolio together. I'm guessing this is largely DIY. The second thing is to have a long-term view. In fact, starting at 22 and to have a 23-year view is phenomenal. I think, again, appreciation for Bhagya. And the third and the most important appreciation is the SIP amount to have a 10% step up, is phenomenal. And as I read it right, it's per month. And I'm just, wondering how such a good thought has come about, that you keep your SIP increasing at 10% rate, because the numbers are going to be staggering by the time Bhagya is 45. And I will not pick any holes on the selection of the funds, because there's an index, there's a flexicap, and there's also a small cap. And if you're going to be invested for 23 years, I'm sure the returns are going to be rewarding and commensurate with your time and the risk that you take. And not to forget, the winner is going to be your time and the scale up of the SIP, because those are going to be magical when power of compounding kicks in. So I am giving a double thumbs up to this.
Okay. We have about 70 seconds left on the show. So I'm going to make it quick, Salonee. Akhilesh Sinha at the other end, age 62, 35 lakh rupees in ICICI Pru Balance Advantage Fund. Wants to invest another 15 lakhs into the same fund and then leave it for 5 years, after which start a SWP. Is it whether to invest 15 lakhs in a lump sum or through a staggered process?
So I think since it represents a substantially large portion, of his net worth, I would recommend investing it over the next 3 to 6 months because there is a lot of volatility that is there currently. I think it's a great option because he is looking at hybrid funds, which will give him a good balance of debt and equity, and also adjust basis what the fund manager thinks, the market view is going to be. So I think it's a great plan, but maybe look at investing the 15 lakhs over a 3 to 6 months period.
Got it. Okay, both of you, thank you so much for taking the time out and being with us on the show and giving us your thoughts.
Thanks,
really
Neeraj.
appreciate your time.
Thank you so much, Neeraj, for having us.
Right. Thanks, Neeraj.
All right, and that's all on this leg. Thanks so much for tuning in.